It does. Well, let's kick things off with our Thinkorswim chart from TD Ameritrade showing the candlesticks on the NASDAQ daily chart here. So the NASDAQ gaining 1.2% on Friday's session. We also had the S&P 500 up 1.7% by the end of the day, the Dow up 1.4%, and the IWM, which tracks the Russell, we'll take a look at that, up about 1.8% today. So again, a big burst of buying into the close, but the NASDAQ still lagging here, even with a strong day today.
Yeah, it was still down for the week. I mean, the NASDAQ technically, even though it was really nice to see Thursday and Friday's gains, it probably got the least out of it because it's still below the bottom of this regression channel. It's still well below the 21-day line and the 50-day line. So while, look, it's really nice to see that you came off the lows, but it still, doesn't really change the picture of, you know, the NASDAQ and the tech sector just generally being in having trouble.
So, even if we do get back in within that lower regression channel area, it feels like there's going to need to be some more progress than that before we get more positive on this area of the market.
Definitely. The 50-day line, I think even over here, before you can start really feeling confident that, yeah, the NASDAQ's really moving higher. We still have a split market, and that's for sure.
And this morning on IBD Live, we were talking with David Ryan, how it seems like the NASDAQ might even be shaping a head and shoulders pattern. But we'll also take a look at the weekly chart here to provide an additional technical perspective on what we're seeing with the NASDAQ. Ed, what are your thoughts on the weekly picture?
Well, you can sort of see these long lines. It was a pretty wild week, but that's sort of common. You're going to see a lot of wild action just in general if you look at stocks. It's just stuck below the second straight down week. The move wasn't ultimately, the weekly close wasn't this huge move, but a lot of wild action. And, the NASDAQ has gotten weaker this week after and breaking through some important levels.
So it's this continuation of this bifurcated market, which actually was in question maybe midweek. It was looking like everything was kind of getting dragged down. But now at the end of the week, things are looking a bit better for some of the other major indexes, Ed. So, when looking at the Dow, which had a strong gain today, followed by a nice upside reversal at around the 21-day line yesterday. It's getting awfully close to those prior highs not all too long ago.
Yeah, I just had to check to see if it hit a closing high. This is the diamonds, so we can see the real time because didn't want to see anything delayed on this. Don't want to miss out on the last few
For
minutes of
sure.
trade. Yeah, really nice action yesterday. It got on below the 21-day line. That was weak, especially since this was the best looking index to see that breaking through there, but came much better. All of a sudden, a week that was sort of sideways and choppy looks a lot better. The problem is that a lot of the real economy stocks had much wilder weeks, and so it would have been easy to be shaken out. You buying breakouts up here, and then you get shaken out down here. So it's just difficult to navigate, even beyond what the indexes seem to show.
That's right. Well, let's also check in with the S&P 500. We could pull up SPY, keep the ETF theme going here. So the S&P, while the Dow came down and had an upside reversal at the 21-day, the S&P came down to its 50-day and saw an upside reversal there. So that was pretty bullish and followed up on that with another strong gain today, and it too getting close to those prior highs.
Yeah, this might have been the most important action because on Wednesday it got below the 21-day line and we put the rally under pressure.
Right.
To like the market direction, just because at that point, and we'll look at the Russell as well, that could even worse. The NASDAQ was breaking below her, breakouts were struggling to so this action going through the 50-day line was really grim, and to have this rebound and then come back here all of a sudden right near highs, that was very positive. It's probably the most technically positive of all these indexes because it was looking weak and now all of a sudden is knocking on the door of record highs.
So a very key development by the end of the week here. And you mentioned the Russell, so let's check in on IWM, tracking the small cap index. Visually, this just shows you what a round trip the Russell had. It was looking pretty dire there midweek. Found a bottom, upside reversal too. Got a theme here. And IWM, it looks like it managed to close right around that 50-day, Ed.
Oh yeah, now it looks like it's closing at, it's just like just a smidge above the 50-day line because it came crashing through the 21-day line, 50-day line, nearly undercut the March lows, really was not looking good at all. So the combination of just plunging like that in the S&P is why we went into market under pressure. It's come back, so it's right at the 50-day line. Have to see if it really can get back above, seriously above it and get it back above the 21-day line. But this is somewhat more of a reflection of a lot of stocks. You saw these kind of moves, and you saw these kind of moves. There's a lot of stocks where they were doing things, and you saw this up and this down and this up. And it's one thing to have a sideways market. This was more of a sine wave where it's going up and down. And if you're buying at the tops, you're going to quickly come down on that. And it's just very difficult to navigate.
Exactly. We've seen a number of good setups, potential breakouts, but we've been saying all week, and I believe the week prior, that it seems like if you are going to buy those breakouts, A, go in small, but B, it might be a better environment to be buying on pullbacks so you don't get shaken out on those breakouts.
Yeah, absolutely.
Well, speaking of breakouts, we have to look at
March 26, 2021 Market Commentary. March 27, 2021. Len Martinez, PhD, CPA, President, Bull Valley Advisors. Investing in value stocks with positive price momentum. Wall Street closed in the green on Friday as stocks related to an economic reopening performed better again. Also, bank shares rose after the Federal Reserve announced that restrictions on bank holding company dividends and share repurchases currently in place will end for most firms after June 30, 2021. On the macro front, PCE figures showed that personal income fell less than expected, whereas spending declined at a faster pace and prices point to tame inflation. Meanwhile, the 10-year Treasury yield rose to 1.665%. The Dow Jones gained 453 points, or 1.4% to 33,072. The S&P 500 increased 65 points, or 1.7% to 3975, another record close. The Nasdaq added 161 points, or 1.2% to 13,139. During the week, the Dow Jones climbed 1.4% and the S&P 1.6%. Whereas the Nasdaq dropped 0.6%. All eyes turn to the U.S. employment report next week, which will probably add to signs of a gradual job recovery, as well as worldwide manufacturing PMI surveys and an OPEC Plus meeting that is expected to offer guidance into the coalition's production plan for May. Elsewhere, key data to watch for include U.S. construction spending, UK and Russia Q4 GDP updates, Eurozone inflation and business morale, Japan's Tankan survey, industrial production and retail sales, Australia, India and Turkey foreign trade figures. The US dollar index traded above 92.7 against a basket of currencies on Friday, not far from a 4-month high of 92.92 hit in the previous session, and on course for a 0.8% weekly gain as better than expected weekly jobless claims numbers and upwardly revised GDP figures reinforced the view of a robust U.S. economic bounce. Meantime, fresh PCE figures painted a mixed picture. Personal income fell slightly less than expected while spending declined at a faster pace and prices pointed to tame inflation. Beyond these upbeat numbers, the swift rollout of coronavirus vaccines combined with ultra-easy monetary policy and unprecedented government spending has given investors more confidence in the path to economic recovery. The yield on the benchmark 10-year Treasury erased some gains to around 1.64% on Friday, but remaining close to levels not seen in over a year, after data showed consumer spending fell more than expected in February and personal income tumbled the most on record. The PCE price index edged up 0.1% as expected. Several auctions have been in the spotlight during the week. Both the 2-year and 5-year auctions saw solid demand while demand for the 7-year auction was below the recent average. Yields have been rising since August, but the upturn momentum gained speed from mid-January as coronavirus vaccination and further fiscal stimulus support prospects of a strong economic recovery, but can lead to a spike in inflation and debt levels. Still, Fed Chair has been reiterating any spike in inflation would likely be temporary and showed no concerns over the recent rise in bond yields. WTI oil prices increased 3.9% to $60.82 per barrel, and Brent crude increased 4.1% to $64.48 per barrel over concerns that the Suez Canal blockage may last weeks and tighten supply. On Thursday, officials stopped all ships entering the shipping lane, and a salvage company said the vessel may take weeks to free. Despite Friday's rebound, oil prices declined during the week and booked their third consecutive weekly loss, with both benchmarks dropping nearly 3% over demand concerns stemming from rising coronavirus cases in multiple regions of the world. Spot gold prices increased 0.4% to $1,731.30 per ounce, but the metal declined 0.7% in the week and booked its first weekly loss in 3. On the macro front, the USD increased after PCE figures showed that personal income fell less than expected, whereas spending declined at a faster pace and prices point to tame inflation. Meanwhile, the 10-year Treasury yield rose to 1.665%. Silver held above the $25 an ounce level on Friday, but was on course for an over 4% weekly drop as investors continued to move into the dollar index in the light of growing concerns over surging coronavirus cases across Europe. Meantime, Treasury yields rose again in response to a weak 7-year auction on Thursday. LME copper futures jumped almost 2% to trade above $4 a pound on hopes of global economic recovery amid strong labor and GDP data for the U.S. and President Biden's plans to accelerate the vaccination program. However, a stronger dollar, sanctions between China and the West, and new coronavirus lockdowns in Europe capped gains. Although copper futures remain below a decade high of $4.30 per pound reached in late February, the metal is still up more than 15% so far this year as China, the top copper consumer, consolidated its recovery from the coronavirus blow. The commodity, considered an economic barometer, has been in a massive rally from its March 2020 multi-year low, catching attention from governments of Chile, Peru and Zambia, which are considering further taxes on mining companies to help rebalancing public finances, according to Bloomberg. Coal futures remained above $90 per ton, a level not seen since March 2019, as top consumer China is expected to face shortages in imports of coking coal from major supplier Mongolia after fresh COVID-19 restrictions were reintroduced at the Ganka-Matadeb border, the gateway for Mongolia coking coal to China on March 16. Coal prices are up almost 80% from a nearly 4-year low of $50.45/ton hit in August, supported by government policies, particularly China's ban on Australian coal. Imports and supply issues after producers cut on output as prices weakened during the height of the lockdowns across Asia. Chicago wheat futures traded around $6.10 per bushel at the end of March, having touched on Friday its lowest level since December 28, amid a stronger dollar and favorable weather across major producing regions including the U.S. and Russia. Production prospects in the two major exporting nations were boosted by forecasts indicating moisture this month. Also, Russian agricultural consultancy IKAR said on Thursday it had increased its forecast for the country's wheat crop in 2021 to 79.8 million tons, up from 78 million tons previously projected. Elsewhere, traders looked ahead to U.S. planting estimates next week. Personal income in the U.S. declined 7.1% month-over-month in February of 2021, down from an upwardly revised 10.1% jump in January and compared to market expectations of a 7.3% drop. It is the biggest fall on record, reflecting a decrease in government social benefits to persons. Within government social benefits, other social benefits, specifically the economic impact payments to households, decreased. The CRRSA Act authorized a round of direct economic impact payments that were mostly distributed in January. Personal spending in the United States declined 1% from a month earlier in February 2021, following an upwardly revised 3.4% growth in January and compared with market consensus of a 0.7% drop. It was the largest decline in consumer spending, since the April 2020 record slump as the cold weather weighed on demand and the boost from a second round of stimulus checks faded. Consumption of durable goods slumped 4.7% versus 11.9% in January, and that of non-durable goods dropped 2% versus 6.5% in January. Meanwhile, spending on services was up 0.1% versus 0.9% in January. Real PCE fell 1.2% in February due to decreases in spending for both goods and services. The goods deficit in the U.S. widened to a record high of $86.7 billion in February of 2021 from $84.6 billion in January. Exports of goods were $130.1 billion, $5.1 billion less than January exports. Biggest decreases were seen in sales of capital goods, minus 5.9%, autos, minus 5.9%, consumer goods, minus 5.7%, and food and beverages, minus 5.4%. Imports of goods were $216.9 billion, $3.0 billion less than in the previous month, dragged down by a 10.7% slump in purchases of autos. The University of Michigan's consumer sentiment for the U.S. was revised higher to a one-year high of 84.9 in March of 2021, up from a preliminary estimate of 83, and above market forecasts of 83.6. It was also the largest increase in consumer morale since May 2013, as households welcomed the third disbursement of relief checks and a better-than-anticipated vaccination progress. Meanwhile, expectations were revised higher to 79.7 from 77.5, and compared to February's 70.7. The current conditions gauge rose to 93, above a preliminary of 91.5, and up from February's 86.2. Inflation expectations for the year ahead decreased to 3.1% from 3.3% in the previous month, matching initial figures, while the 5-year outlook rose to 2.8% from 2.7%, above preliminary figures of 2.7%. The data clearly point toward robust increases in consumer spending. Europe's major stock markets held onto early gains on Friday, with Frankfurt's DAX 30 closing up 0.9% at 14,749 and other major bourses gaining between 0.7% and 1.1%, as investors focused on the prospect of a global economic recovery, despite the uncertainty around rising infection rates and the slow rollout of vaccines. On the economic data front, German business morale improved in March to its highest level since June 2019, easily beating market expectations. EU leaders met this week to discuss the COVID-19 epidemiological situation and have agreed to tighten the criteria to authorize the export of EU-made coronavirus vaccines, aiming to secure the bloc's supplies. However, they could not get a deal over vaccine distribution and demand from some countries for additional Pfizer/BioNTech vaccines. For the week, the DAX added 0.9%. The CAC 40 added 0.6% to a one-week high of 5,989 on Friday, after being little changed in the previous two sessions, booted by expectations of a global economic rebound and upbeat business morale data out of Germany. Still, rising coronavirus cases in the continent continued to undermine the mood. France extended partial lockdowns to 3 more areas of the country, and German Chancellor Angela Merkel signaled that she would declare France a high-risk COVID area. For the week, the CAC 40 edged down 0.2%. The FTSE 100 added more than 60 points or 1% to close at 6,741 on Friday, recovering from the previous session's 3-week low, with mining and oil and gas stocks among the best performers, helped by higher commodity prices. Investors across the globe focused on the prospect of a strong economic recovery, despite worries about surging coronavirus cases in Europe. In addition, economic data showed Britain's retail trade rose firmly in February, even as non-essential shops remained in a coronavirus lockdowns. On the corporate front, British insurer Aviva gained after it sold its Polish operations to Germany's Allianz for €2.5 billion in cash. For the week, the FTSE 100 gained 0.5%. The Shanghai Composite added 54.73 points or 1.63% to 3,418.33 on Friday, snapping 3 sessions of consecutive losses and retracing 13-week lows while gaining 0.46% for the week, after the World Bank said China is set to lead the recovery of East Asian and Pacific economies this year, growing by 8.1% in 2021, compared with 2.3% in 2020. On the policy front, China's central bank on Thursday said it would deepen exchange rate reform and increase yuan exchange rate flexibility. Shares of national sports brands rose as the Chinese government joined mainland consumers in pressing global fashion brands to reverse the Xinjiang cotton boycott and correct their mistakes. Meantime, the Hang Seng Index further retraced 10-week lows, adding 480.24 points or 1.72% to 28,379.85. The Nikkei 225 added 446.82 points or 1.56% to 29,176.7 on Friday, extending gains of 1.14% in the previous session, lifting from 7-week lows while closing 2% lower for the week. Sentiment remained positive amid bargain hunting and hopes for a solid U.S. economic recovery supported by accelerating COVID-19 vaccinations, with President Joe Biden pledging to double his administration's vaccination rollout plan. Investors also welcomed official U.S. data showing the number of workers filing for unemployment benefits fell last week to its lowest level before the pandemic. On the coronavirus front, Tokyo confirmed 394 new infections on Thursday, after Japan lifted its state of emergency in the capital and 3 surrounding prefectures on Monday. In local data, core consumer prices in Japan's capital city Tokyo continued to fall in March, but slowed their annual pace of decline for a third consecutive month, indicating that a rebound in domestic demand will help Japan avert deflation. Thank you, and please stay tuned for more upcoming reports. Len Martinez, PhD, CPA's president of Bull Valley Advisors. Len publishes the Bull Valley Advisor, a stock market newsletter for institutional investors, featuring his BVA Value Momentum portfolio strategy. Information in this report and the Bull Valley Advisor newsletter should not be considered as investment advice or an offer to buy or sell securities. Data is derived from sources considered to be reliable, including Morningstar, StockCharts.com, Yahoo Finance, Finviz, TipRanks, Investing.com, ECRI, OECD, Guru Focus, Crestmont Research, Trading Economics, and S2O. Results are not guaranteed. Len Martinez is not an RIA. The data is shown for informational purposes and should not be considered investment advice or an offer to buy or sell securities. Institutional investors, be sure to visit my website to subscribe and ask for a free copy of the Bull Valley Advisor stock market newsletter. www.bullvalleyadvisors.com. Click on the below YouTube channel link to visit my channel and view Almy commentaries. Also like and subscribe to the channel to stay up to date on the latest commentary. Len Martinez, PhD, CPA YouTube channel link.